Maybe I'm about to give away the secret sauce that will end my business. I don't like being a fund manager. I don't give a shit about any of that stuff. I am good at one thing, legalizing disruptive shit.
When's the right time for a founder to bring on somebody internally to do this?
Sometimes the answer is day one. You're not gonna be able to hire anyone who works for me because you can't afford them. If you are someone like Jay or me, establishing your credibility publicly is really important.
I disagree.
If you're not willing to give me preferred, you probably don't need us in the first place. And if you need us that badly, you should give me whatever I need because it's going to multiply for you tenfold. I mean, there have been companies where I like everything except the personality of the founder. And I'm like, I don't want to work with this person for the next 10 years. And so I'm not going to do the deal. If you are an AI founder right now, there's going to come a point where there's going to be some huge winners and a lot of failures.
What do you think most VCs get wrong about regulatory risk?
The first would be
Hey everyone, welcome back to Climb. I'm Jay Kapoor, General Partner of VSC Ventures. You know, on Season 3, we've talked a lot about how AI is changing the way we build and back companies. We haven't talked enough about how AI has changed the way that funds are built and backed. So today I'm thrilled to have on my friend Bradley Tusk, CEO of Tusk Ventures. Bradley works with companies when government, local regulators, and politics stands in the way of them and growth. And he really cut his teeth in the heyday of the sharing economy, helping companies like Uber break through the noise in cities like New York City. Given that we have a similar model where we do equity for services and investment, I thought it'd be great to have Bradley on to talk about how incentives in venture capital have changed, how mega funds have changed the way that funds are built and companies are backed, and more importantly, what AI means for the next generation of capital availability for founders. So if you're thinking about how you find the best investors for your business, how you build businesses in the age of AI, and more importantly, how you raise venture capital in 2026 and beyond, this is the episode for you. Bradley, thank you so much for joining me.
Jay, thanks for having me.
You know, what brought us here is this idea that we've been talking about on Season 3, how is AI changing how we build and back companies? We hadn't really had a in-depth conversation about how it's changing how we build and back funds, right? From an LP perspective, from a GP perspective. And you've had this great post about how the current venture model is broken.
Yeah.
It's now been about a year, I think, since you announced that you're walking away from Fund 4. Just to give a little background, I think Fund 1 was 35. Fund 2 was 70. Fund 3 was 140.
Yeah, we kept doubling.
You kept up, which is the kind of classic story of an emerging manager. And then you decided to walk away. So maybe let's set the stage a little bit. What prompted that decision and what broke first? Was it LP appetite, founder experience, or something else?
So I'm not originally of venture, tech, business, really any of that, right? I started my career in politics. And then I broke into tech kind of by accident, which is I ran the campaigns to legalize Uber all over the US. And I started in early 2011. I'd started my first company, which still exists, a consulting firm that runs big legislative and policy campaigns all over the country. It was fine, but I learned a few things along the way. One, I don't like being a fund manager. I don't like being responsible for other people's money. I really hate asking people for money. And then a lot of stuff that I think people who, maybe love running funds are interested in, portfolio construction, board seats, compliance. I don't give a shit about any of that stuff, right? To me, it was all an annoyance. I am good at one thing, legalizing disruptive shit, right? And that's what I like doing. And I like meeting founders that I think are interesting and betting on them. And so we were raising Fund 4, and we were about to circulate the subdocs for the first close. And I think it would have been around the same size as Fund 3.
Sure.
So we weren't going to double again, but it would have been, roughly based on, we were at, 50 million or so in commitments for the first close. So we would have got to about the same place.
Yeah.
And it kind of hit me that I didn't need to raise outside capital, because when I looked at all those companies that I just named, none of them those are all hot deals, right? And none of them needed my money. What they all wanted was our political help, right? They wanted us to solve whatever regulatory problem they had. And I started asking some of them, like, hey, if I had just asked you for equity like I did with Uber or Clear, would you have done that instead? And they were like, yeah. And so then it hit me like, I'm doing all these things I don't enjoy doing. What if instead I kind of created a new hybrid model that is part what I did initially, part what I did subsequently. So now we're taking equity for services like I did with Uber and Clear, we're also taking our pro rata, and then I'm either doing that off my own balance sheet or SPVs with my former LPs or other friends and people like that. And I just think it's, for me, a far better model, much more upside. Now, there's one meaningful piece of downside, which is I am spending a couple of $1 million a year in my team who has to do all of the regulatory work and comms work for our portfolio companies without management fees coming in to pay for it, right? If there's no outside capital, there are no fees.
Do you also take like fee clients? So, you got startups over here.
Yeah.
Maybe there's just a regular way.
But in the sense, different business. So Tusk Strategies, which was that first company. I don't run it anymore, but I still own it. And that's a pretty profitable company.
That makes sense.
And so I take a couple of $1 million of profits from Tusk Strategies, use that to pay for Tusk Ventures. And then, so I own the downside, but I also own the upside.
Yeah.
So the employees of Tusk Ventures have about 25% combined of the equity. So basically kind of inverted the GP-LP model where now effectively I'm the LP in many ways. And we'll see. But when I think about, when we can get into the math and how I've been modeling it, but I can afford to lose the money, luckily, if everything goes to zero. But if everything kind of works out the way I hope it will, it's like a 40 or 50x. And that's not even being crazy with estimates. And I've got a very high risk appetite. And so to me, it's, if you have a skill that people will give you equity for without getting capital in return, and you have the cash to be able to cover your costs of doing so, and the risk appetite, it makes sense to do it that way.
Well, let's talk about a couple of the assumptions you're making in that model, right? We'll get right into it. So one is, you can go to founders and say, hey, if you are willing to give me equity instead of taking my cash, would you do that, right? Instead of doing that. So that's one big assumption.
And some say no.
Right. And I think I'm going to get to that in a second. So I think that's a big assumption. The other assumption is you've got the capital to be able to, execute this model and the risk appetite to do it, which, again, I think not every agency, marketing agency, PR agency, whatever, would do. And then I think the last bit of it is that when you go and do an SPV into these companies, there's going to be LP appetite for it. And so I think those are three big assumptions that we're making here.
Which all require me to just do a lot of work.
Yeah, no, right? Well, let's start with the equity one, because I think, again, a lot of the audience for the show is founders, and so want them to think about, hey, how do you build a cap table?
Sure.
I'll say from our perspective, one thing founders do like when we offer equity for service and a check is they say, you're putting your money where your mouth is.
Right.
You have real conviction in what I'm doing. This is not going to be about, do 6 months of work and then F off and move on to the next thing.
Right.
You're aligned with me on my cap table for a while.
Right. And that's because you're writing a check or because you're taking equity instead of cash?
Well, sometimes we do both, but we lead with the check, right? So VSE Ventures is a standalone $20 million vehicle. So typically I'm writing a $500 to $750K check. And so when I go to a founder and I say, you've got a story that I think we can turn into a category leader, and I believe in it so much that I'm writing a check, that's something no other agency or vendor is doing for them, at least in the PR world, right? When they come for regulatory, we can always point them to Tusk, right? But for us, that's a unique value prop.
Sure.
No other agency is doing for them. At the same time, I tend to find, and you tell me if you agree or disagree, a lot of the best founders are very equity tight these days.
Sure.
If cash, they believe in their business.
It really just depends on the market cycle, right? If cash is plentiful, then they're equity tight.
We're in the market today where cash is plentiful.
Correct. If cash is tight, then they're equity generous.
Yes.
And so, but keep in mind, I don't take anything where I don't believe that our work specifically can truly move the needle for the company's future, right? We are not passive investors. So fundamentally, for you to give me 1.5% of your company, let's say we're meeting you at seed, you have to believe, and I have to believe, that our work is going to meaningfully increase your TAM, build a regulatory moat for you against your competition, things like that. Also, because I'm only interested in companies that are highly regulated, the other value, so the main value would be 1, all the regulatory stuff, 2, comms, but then 3 is there is some value at this point to having our name on your cap table because, like, for example, Doctronic is one of our portfolio companies, and Matt Pavel was one of the founders. He was on a podcast recently, and I was quite pleased at the question they asked him, which is they said, we see that Tusk Ventures is on your cap table. Clearly, you're taking regulation very seriously, right? And so I think there's a market signal after, I've been in and around politics for over 30 years. I've been doing stuff with startups for almost 15 years at this point. And so there's market value, A, I think in the symbolism of our name. And then B, one other thing that I spend a decent amount of time on is fundraising. Not in that I'm out there finding you investors. I mean, if I know people, I'll happily do it. It's in the diligence, talking to VCs who are looking at it to explain, here's what I think the regulatory issues are. Here's how we are going about solving them.
Yeah.
And here's why I chose to take equity in this company and bet on this founder as opposed to being paid in cash.
It's a high level of conviction coming from you being on the cap table, to push on that a little bit, if you don't mind, right? One of the things I've seen as funds have gotten bigger, which you talked about in your kind of initial setup of our chat today. As funds have gotten bigger, they add operations teams.
Yes.
One of the most hired for roles I'm seeing on a lot of these larger, mega funds north of $1 billion is a regulatory operating partner.
For sure.
So talk
I've
to me
thought
about
that, wondered about it, and so far at least, and maybe I'm about to give away the secret sauce that will end my business, but their regulatory teams don't do what we do.
Okay.
They're kind of like general counsels, where they're like, oh, we can help find the right lobbyists, the right PR firms, the right, grassroots, whatever it is, or more likely take Andreessen Horowitz. They have like a platform team that's bigger than the U.S. Post Office at this point. They raise money for candidates. That's what, and there is some value in that, and clearly Andreessen bet on Trump and is cashing in incredibly well on that, so good for him. But what we do specifically is we go pass laws in states. So for Doctronic, we just passed regulation where now Utah is the first state to allow prescription via AI. So no longer a human being, just Doctronic itself through its AI can say, okay, Jay, you have a sinus infection. We will send in a prescription to your pharmacy to fill it. I have yet to see a platform team at any fund that does that. That goes state by state, city by city, passes laws, blocks laws, writes regs, blocks regs, deals with procurement, deals with unions, all deals with the media around a particular regulatory issue.
When you look at some of the co-investors you've worked with, or even the ones that you have seen pass on some of the deals that you're in, what do you think most VCs at this kind of seed through, let's say, Series B stage get wrong about regulatory risk?
I mean, I think the good news is this. I do think that awareness of regulation in politics has improved materially on both sides of the equation, both on the founder VC side and on the regulator side. So, and on the VC side, I would say, I remember especially in the early days, the typical conversation with the founder would be, me explaining the regulatory issue and then them saying, no, you don't get it. I went to Stanford. I was in Y Combinator, Andreessen or Sequoia or whoever, Kleiner Perkins is on my cap table. So when these stupid regulators see what I want and I explain it to them, they're just going to give it to me. Yeah. And I'm like, you are so clueless that you're going to fail. And so now that arrogance has dissipated because enough startups have suffered enough regulatory problems that it has sort of smacked VCs and founders into a little more reality, but still even today, if I'm on a Zoom with a founder and it's very clear to me that they don't know what they don't know, or they're not going to just get out of the way and let us do our jobs, then I have no interest in working with them.
When's the right time for a founder to bring on somebody internally to do this versus work with an external party?
It's a few things. So one would be, it's always sort of a stage and capital question to a certain extent, but let me break your question down into two pieces. So the first would be, when is a regulatory issue top of mind? And not to tout myself too much, but I wrote, my first book is called The Fixer, and it literally gets into specifics like, how do you think about all of these questions and what should you do? So if you're interested in this stuff, go check out The Fixer. But some of it is, do I need permission on the front end? And what happens to me if I don't get it? Yeah. So like with Bird, it's like they'll impound the scooter. All right, fine, right? If it's Lemonade or say Coinbase or whatever, it's like, you're going to go to jail. Different story, right? So the first question is just, when do you need to engage from a regulatory standpoint? Sometimes the answer is day one. Sometimes the answer is not until you have to.
Yeah.
Now, if I were a smart founder, I would find someone, and some do, and I'm always impressed by them, find someone like me and just say, hey, I just want to meet you, not because we need you today, not because you'd want to, because there's nothing for you to do today, but when the time, I know the time's going to come, I want to be able to get you on the phone, right?
Yep.
And founders who listen to this, feel free, if that's your situation, to reach out to us, and we're happy to at least meet you and,
Consultation call.
Yeah. And that we're, but we like this stuff, so we're always happy to kind of learn about what people are doing anyway.
Yeah.
The second question is when to bring someone in-house. And then typically, to me, that's less of a regulatory question and more of a capital question, which is when you are early stage, all of your money should be going to engineering and go to market, right? You really don't want to have to spend money on anything other than those two things, which means, having internal regulatory or comms people at that stage is probably not the best use of fairly scarce resources. I guess if you're an AI company at Seed A that raises $400 million, different story. But even then, you're raising that because your engineers are wildly expensive, right? So to me, like the best way that these things unfold would be, let's say someone at the earliest stages does need regulatory help. We'll take equity for that. You're not spending capital on that. We give you a level of work that you just can't get with an employee, because if nothing else, keep in mind, we have a team of people doing it, right? So that's different than one person. And with all due respect to whatever founder it is, you're not going to be able to hire anyone who works for me because you can't afford them. Yeah. And the level of work we do, they're not going to walk away from being able to do really intellectually engaging high-level work for multiple startups to just work for one, no matter how special you think you are.
Yeah.
And so in a perfect world for me, we'll come in at the Seed A, we'll do our thing, and then by like the B or C, it's like, okay, you know what? This, like, Ro's a really good example of this, right? Where when we came in, Zach needed us because he had created a new model. It's funny, what we mentioned with Doctronic, with prescription via AI, part of the reason I was interested in working on Doctronic and confident that we could deliver was we helped legalize prescription via text, right, for Ro. And so in the early days, that was our job. And then eventually we got to a point where it's like, okay, you're becoming a really big company. We've kind of settled this issue. And then we've ended up working with them on compounding and other stuff too. And he and I are friends and we still talk all the time. But like, putting that aside, they got to a point where it's like, okay, you're ready for someone in-house. The needs are not so severe that you need us every single day. You shouldn't need to still spend money on us. We did our pro rata and whatnot. But and so that actually is kind of the ideal way for it to unfold. But obviously it's startup world, so weird shit happens every day.
Yeah. You mentioned one thing that I thought was really interesting, and I counsel founders on this a lot too, which is, if you are, from our perspective, it's about marketing and PR, right?
Yeah.
Very similar model to you guys, with the exception that we also still have a standalone fund in addition to the PR agency. I tell founders a lot, if they've never hired a marketer before, how do you know what to look for? Right? The best ones, to your example, will do a lot of consultation calls. They'll talk to a lot of their friends who have CMOs and say, what's that CMO do really well? They want to understand it. But when you're a startup and you're going really quickly, you sometimes don't have that. So oftentimes what I will see a founder do, and especially when they work with us, is they'll spend 6 months with us. They'll understand, hey, this is what a top tier PR agency does from an operational standpoint. Right. And then when they go to hire internally, they'll come in and say, hey guys, can you sit in on my interviews? Or can you actually help me figure out who we need to bring in?
For sure.
Because
Same
now
thing.
I've worked with you, but the volume of work that I need goes beyond the scope
We'll help
of what
interview or look at or recruit people when they get to that point, because ultimately I have a lot of stake, right? If I own 1.5% of your company or whatever it is, I need you to succeed as much as you do, or not quite as much, but still. So I think it makes sense. But here's the other thing that you do and I do, but I think other people should think about, which is you have established credibility in the marketplace, where now when you say to someone, hey, here's what I think you should do.
Yes.
Because in part you're public, you have the successful podcast, you're out there in the world, external validation creates credibility, right? So for me, the reason why I go on CNBC every other week. I host my own podcast. I write books. I give speeches. I have a column with the New York Daily News. I have a Substack, all of that stuff. Part because I just enjoy it, but part also because all of that, when people see you on TV talking about how to regulate data centers or crypto or prediction markets or whatever it is, they're like, oh, that's the guy. Right.
Yeah.
And so I think that part of it is what you describe, but part of it also is what you're doing, even if I just revealed the secret sauce that you didn't want to reveal.
No, it's not at all.
Which is, if you are someone like Jay or me, establishing your credibility publicly is really important because that gives you the validation that you don't like. A founder and I will discuss whether or not I want their equity, whether or not they want to give me equity, whether they have a real problem, whether we can solve their problem. No one ever says, oh, tell me why you know what you're talking about politically. It is assumed that if I say something, it's probably pretty well informed and right. I can be wrong.
No. I think you're spot on about that.
That takes work.
And I think the more complicated, so I'll kind of pat ourselves on the back since you teed me up for it nicely.
This is a conversation.
Exactly. We work with dirty, dusty, and dangerous industries a lot in this fund. It's a passion area of mine. It's not the only thing we do, but it's something.
Give me some examples.
Yeah. So construction, manufacturing, transportation, public safety. I have 4 investments in public safety, one which we share.
Yep.
And so to me, when I say dirty, dusty, and dangerous industries, I'm talking about legacy industries that maybe missed the wave of SaaS, but are now actually really opening up because of AI, right? And I think about that a lot. In the old days, let's say in these dirty, dusty industries, we had Procore and Service Titan, and there's a couple of things that people were using. And now the availability of these tools for somebody, voice AI for HVAC contractors, right? Massive.
Totally.
And now you can actually run a multi-million-dollar HVAC business with a couple of employees because all of your customer service is being done through voice AI.
Right, you just need the people to actually fix the HVAC.
Exactly. So the point that I make to a lot of founders there is I say, especially if you're in those industries, if you're in consumer, fine, go build a media brand, go build TikTok, whatever. But if you are in a legacy industry, if you're in a dirty, dusty, and dangerous industry, you have such a white space to go and build media, to go and build content, to do a podcast. And I'll give you a prime example. One of my founders, Matt, runs a company called Multitude. They sell to police agencies. So 18,000 police agencies out there. Matt started a podcast, on our encouragement and he was on my show, seeing how easy it was. And he started a podcast called The Innovators of Public Safety, Tips. And he goes and he interviews police chiefs, and he goes and he interviews data analysts at, innovative police agencies, federal guys from DHS. And it's just a conversation about innovation in helping keep communities safer, innovation in, surveillance, and how we're doing it in a way that is, public forward, not something that should be scary and minority reporty. And as a result, when he gets off the camera, folks go, Matt, that was a really interesting point you made there. How is your company doing something about that?
Right.
And then he's turned those guests into customers. Right?
Totally.
So that's how a company grows to $3 million of contractual ARR in the first year and a half of the business.
Totally.
The media became a way for him to establish credibility with a customer 6 months before he sold them anything. And I say that if you are listening and you're building in legacy industries, you're not competing with 60 other podcasters.
Right.
So to me, it's such an easy, low-hanging fruit. And what you and I are doing today is dog fooding the things that I take to my founders. And I say, everything that I've done on my show over 80 episodes, here's the playbook.
Right. I mean, even when I think about the listenership of my podcast, I don't really care what the total number is. I care that the people who are listening, I think we have around 10,000 listeners.
Yeah, great.
But, it's fine, right?
Yeah.
But they're all pretty high value. No one who is just interested in what the Kardashians are doing is listening to my podcast, right? I'm talking about the intersection of technology and politics, which could range, to a lot of different stuff. It's really whatever interests me intellectually at that moment. But ultimately, you're only listening because these are things that you're interested in and working on.
Yes.
In which case, so therefore, if you're a founder, a politician, whoever it is that I invite on the show, you're hitting a high value audience because they are the people who are actually interacting with your world.
Yeah. So on the topic of value add, right?
Yeah.
This is kind of coming back again to this great article you wrote about the current venture model. Value add is this thing that every emerging manager, every GP of a larger fund, they shout it from the top of their lungs. If you're advising a founder, maybe you're on their cap table, maybe they're talking about working with you, and they're thinking about who to bring on their cap table.
Yeah.
what value add should they deeply prioritize and which value add is bullshit?
Yeah. So I would say this. The great lament I hear from so many founders after they're maybe a couple of rounds in was the getting snowed by VCs about the value add, right?
Okay.
So when someone's value adds that they're a great board member, or it will help you find engineers, or we can connect you to, the potential customers, whatever it is, once in a while that turns out to be true. The vast majority of time, that's just someone selling to win a deal. And my view would be when you have a very specific need, marketing, regulatory, whatever it might be, and somebody, whether it's as an investor or equity for services, can tangibly fill the need, not just giving you advice or coming onto a Zoom once a quarter, but they are working on it independently of you every single day. That's value add, right? And by the way, there are times where the answer is you just want money. That's fine, but then be honest about what that's. And there's nothing wrong with that. Without money, you can't operate, right? But so there are investors you might take simply because the check is good, or you even like the signal that they provide. And there are other times where if you're truly looking for value add, the question to ask yourself is, when I'm not talking to this person, are they doing something for me? And if the answer is no, then there's no real value add.
Yeah. I'll give founders a way to test that, actually. And so few founders do it, which is actually ask that investor, can you give me the last 3 founders you help with on that thing?
Yeah.
The lack of references, especially in today's very frothy, fast-moving, talk to you Monday, give me a term sheet Friday market, feels like we're back in 2021. Founders just don't do the references.
Totally.
Blows my mind.
Right. We're always like, hey, here's dozens of founders to talk to. And by the way, sometimes there's a company where I know they're not going to succeed. And I really, it's that 80-20 rule, or like, I really don't want to spend time on their thing.
Yeah.
But then I'll like, fuck, well, if someone calls them, I don't want them to say this guy abandoned me. And so, I do at least whatever I can. I'm not going to go crazy and use up every chit that would be helpful to a company that is going to succeed.
Yeah.
But whatever I can, because I think that founder reference is important. And, anyone that we're talking to, if you're listening, like, go out. I can give you a list. You can do it on your own, whatever. But like, talk to founders, and because that ultimately will give you the answer.
That's the benefit of being public too. I'm sure you see with your Substack and your podcast is that people know who you've talked to, who you've been on, and it's easy to kind of call you up and go, hey, what do you think of Bradley? Right?
Yeah.
Right. And so I think that's the other thing too is I tell founders a lot more as like, have a public presence, even if you don't think you're in an industry that needs it.
The other thing I would say, it's funny, this happened yesterday, which was I didn't really have a lot of relationships at Lightspeed. But they're on the board of Doctronic Investors. And there was a board call a month ago that I'm not always on the board calls, but I went on because there was a specific regulatory issue to discuss, a strategic issue about the FDA. And then, the partner from Lightspeed, afterwards emailed me. He said, oh, hey, I'm going to give this speech to the FDA and we talk this and that. And then we just started talking. And then yesterday he sent over a company, right? And so if you're helping a company and you're succeeding, you don't assume that the investors in that company are seeing it. You do your best without being annoying to get in front of them, because then when they're like, oh, great, I have problems in my portfolio. Let me see if they can help.
Yeah. Yeah. It's how we got LPs too, believe it or not. When we raised the fund is we have 88 LPs in our first fund. I call them the crazy 88 because they probably had no reason to take a bet on us when they did. And a lot of them were folks that we had worked with before, right? That I had made money for when I was working at another fund, founders that we had supported. And not only did they, bring us more founders that we could invest in, but they also said, hey, by the way, I'm investing in this guy's fund. And they brought in other fellow founders that they had worked with. The referenceability, I think, is kind of a lost thing here, but it becomes really valuable when you're public.
Like when I was raising outside capital, a thing that I ran into all the time were institutional investors afraid of headline risk. And they would say, well, you're out there working on a million different things, sometimes out of your fund, sometimes out of your foundation, sometimes out of your consulting firm, sometimes just stuff that you're saying and doing publicly. And if you do something controversial, what if it makes us look bad? And I always answer, I'm going to do something controversial that I'm going to get attacked on. Like there's 100% certainty.
You're waiting on the mayoral race, I feel like, on a weekly basis.
And that pissed a lot of people off. A lot of people in the hedge fund community were really angry at me for my take on that. My argument was my value add is that I am engaged in politics, and that's why I know how to do what I do. And the good comes with the bad. So, the one detraction would be to be out there publicly and be successful. Typically, you're not just playing it super safe, because if you are, who wants to listen to you? Who wants to read you? Whatever it is. And so that is an issue that I've had to deal with. And it was one of the reasons that I was happy to stop raising outside capital, because, someone that works at, the state of Florida pension, investment fund, I get that, they want to go home at 5. They don't want to get yelled by their boss because some emerging manager they invested in said something about abortion that made someone upset in Florida. So I understood that. Yeah, I was sort of a square peg in a round hole a lot of the time. So that would be one alternate consideration.
No, I think it's a very good point, and one worth considering for emerging managers. For a long time, I was like, oh, I think the goal is for every emerging manager to go be institutional one day, to go raise 150 to 200 million, whatever Union Square has done, be slightly below that, right? But the reality of it is, you are right. There is a risk appetite for those institutions that has to be calibrated. Whereas when we have 88 individuals and former operators, right? I can kind of say whatever the hell I want.
Correct.
It becomes different when you've got a university endowment and a pension for a hospital or something that's involved here. So I think it's a very fair point. On the topic of fund sizing, because that was one of the really interesting observations you made, and I love it, by the way, because a lot of people pontificate, but you gave real numbers. You were like, if you want to be in a fund, raising business today, you're either going to be north of $1 billion and you're going to be this exceptional fundraiser, or you're going to be sub 100 million and you're going to keep your fees really close. I disagree.
Okay.
So I'd love to share with you why. I think sub 100 million for the next few years at least is going to be an exceptionally difficult place.
Just because of valuations, because of AI?
I don't think it's just the valuations. I think when you talk to LPs today, there is a level of impatience they have because of AI. It's not just the valuations, it's this whole speed to X million of ARR. That there is a universe of LPs that understood that venture capital was a get-rich-slow business. It's going to take a long time, but the outsized outcomes are going to be so massive. I think that universe of LPs, now they've got access to secondaries in these companies. People are going out there selling Anthropic secondary or whatever. Mm-hmm. They've got access to more funds than ever before because, hey, it used to be really hard to get into Andreessen and Sequoia, but those funds are bigger than ever before. So if you're a large family office, you're saying, hey, I could put my money into sub $100 million, fund manager over here, and probably going to lose most of it, but maybe it becomes big. Or I've got a certain level of certainty coming into later stage tech and AI exposure. Why would I put it
push
over
back
here?
in two ways?
Please.
One is, from what I can tell, the performance of the mega funds oftentimes is not that great. Now, it might change. AI might change in the sense that if you're in Anthropic at a $10 billion valuation and then it goes up to 400 million and makes it, right? So there was really interesting, I don't know if you saw it op-ed in the Times yesterday by Sebastian Malaby, or predicted OpenAI will go bankrupt. I don't believe it, but I didn't think it would read it. I didn't think it was totally, in fact, I'm going to have him, we reached out to me yesterday, he's coming on our podcast, because I didn't think it was all wrong either, which is they are borrowing collectively trillions of dollars to build data centers that I don't think are necessarily that the form of compute needed for generative AI will be the best way to do it. And B, politically, I don't think there's going to be the permitting and zoning available to build those data centers, because those data centers impose so many negative externalities in terms of higher utility costs on consumers, i.e. voters, that I think that local politicians are going to realize this and say, I'm not giving you the permit.
NIMBYism for data centers.
Well, it's not even really NIMBYism. In this case, NIMBYism is like, I don't want poor people in my community. This is, I don't want my voters to have to subsidize Jensen Huang and Sam Altman. Why should my person who's an electrician pay 35% more in their utility bills because these guys are doubling energy consumption? So if that's true, then I think a lot of the hyperscalers might be in trouble. Now, there's alternate forms of compute. There are inference models, things like microgrid nuclear. I mean, there are solutions, but they're not necessarily the way that they plan for it. And I'm not sure they need to take on all of this debt.
Yeah.
But overall, I would say I get that if you are a pension fund, no one's going to fire you for investing in Sequoia or Andreessen or whoever it is.
Name your mega fund. Yeah.
Fine. One of those Texas teachers, and one of them a couple years ago, their whole investor, like the analysis of their performance got leaked. And you got to see how a lot of their investments in the biggest funds were, and they were like usually way under a 2x, which is not a venture-like return. On the sub 100 million, and maybe, I don't remember exactly what I wrote, but maybe I should have been more precise, you have to be differentiated.
Yeah.
If you are a sub 100 million generalist fund, forget about it, especially with valuations where they are today. But if you're a sub $100 million fund, but with exceptional differentiation, and therefore I think it works, right? So I still think that fundamentally, like if you take our third fund of 140, our investors are going to make money just based on where the deals are. We'll make some money, but you got to return the 140, fees, everything else. And then you got to give 80% of that money back to the LPs. And at that point, the 20% left may not be that much, right? Whereas our fund won at 35 million, the carry was fantastic.
I think the GP carry math, makes perfect sense to me. The point that I'm thinking about is like, actually, I think because of how big the rounds are getting at seed. I mean, dude, when I started in this 11 years ago, a seed round was $3 million. Now the median is like 5, right? 5 or 6. And so now you're talking about a seed round of 6 million. To lead that, you're writing, $3 million checks as a lead, which if you're building a portfolio of 30 investments on average, it's 90 million right there.
Right. With a few caveats.
Okay.
One, like you said, with AI, it's like we're in 2021.
Yeah.
And what I'm partly seeing is just a really irrational variability of valuations and round sizes for companies sometimes doing the same thing.
Yeah.
Right. So I saw one company in the mental health chatbot space that didn't really even have a product yet that had a $350 million valuation because of the background of the founders. And I've seen others that have a $50 million valuation, right? Now, it doesn't mean that the 350 is not going to be a better company. It might be, but I had no interest in their equity because my view was, I don't think there's going to be enough upside for me to take the risk. That's one. Two, I think when it comes to AI specifically, there's generative and then there's application.
Yeah.
And if you are not a north of $1 billion fund, I don't know that you should be investing in generative AI. I just think that you're too small of a player.
Yeah.
Whereas if it's, okay, this company is using AI to totally redo the way that HVAC works, that to me is still going to be a much likely a more reasonable valuation and a lot more upside.
With the caveat that those businesses grow slower than some of these generative companies, and you have to find an LP audience.
Well, that's partly gets back to why I
that.
didn't want anymore to have outside investors, because I have found with a handful of exceptions, it's, when I got into venture, they're like, well, it's 7 years. I'm like, it's 10 years.
It's 12.
Right?
Yeah.
So even Uber, I got in at the Series A in 2011. I think I still waited 7 then, and they were already been around for a couple of years.
Yeah.
7 years to see anything written back from it. So but again, this all kind of gets back to the original premise of the question, which is, I think that oftentimes funds have pressures placed upon them by LPs that are not ultimately best for the fund or the company or even the LP. And I think founders get pressure from funds. I have a founder that has, raised a Series A and built a great company that is already profitable, and he doesn't want to raise more money because he just gets diluted. And, even my own team was, and this was on the outside cap, the venture fund, not the equity services, was like, well, we want to put in more money. And I was like, he doesn't need it, and I kind of said to him privately, we'd love to invest more, but you should do what's best for your company.
Yeah.
And there are some new ideas we have that might require raising, but anyway, the point is there are human pressures and emotions that lead often to not fully rational economic choices.
I deeply agree with that. And I think we are in a incentive misaligned time as fund managers just to kind of, make it more articulated for listeners, when you raise a $20 million fund like we have, you have, we're in year 4 of our deployment. We're in our final year of deployment. We have a certain number of years where we want to get as many checks out as possible. And you need to see markups in those checks so you can raise your next fund.
Yeah.
And so what it actually does is not just change how you advise the founders you're working with, but also changes the founders you pick.
I hated the pressure I felt at the end of each fund's deployment to make investments that were based somewhat on the optics of the next fundraise.
Yeah.
I hated that.
Yeah, it sucks.
Yeah. And that was, again, a reason. Now, look, to be clear, Jay and I are in a very privileged position in that the whole thing we're talking about only works to begin with, despite putting everything else aside, if you have something of enough value that a founder will say,
100%.
I want that, I need that, I will pay for that.
Yeah.
If you don't have that, then the only way you get into companies is with capital, and most people are not rich enough to have to do it themselves, which means you have to raise outside capital and play the whole game. And check out that Substack that Jay mentioned. I tried to lay out in there, and I've done a few since as well, that lay out if you're going to take this approach, here's what specifically you should be able to think about and do. And then, by the way, and feel free to reach out to me if you have this model. We have a lot of experience and thoughts now around the structure. We didn't even get into that, right? Yeah. Are you taking warrants? Are you taking preferred? Are you taking common, pro rata? And we have learned over the years what works best. I think. Can
we touch on that for a second?
Sure.
Because we've evolved the way that we do it.
How do you do it?
We do it through warrants. So we do warrants preferred. Yeah. So we've kind of figured out from a tax standpoint,
correct,
and where the burden comes on
Should
our
we explain
LPs.
why the warrants make sense?
Please, you go.
Yeah. So I mean, it's basically when the taxable event occurs, right? So if you're just getting shares, not warrants, when you're getting the shares, you're paying taxes on that because it's considered income.
Yeah.
That's effectively an unrealized gains tax, which is insane. So the left has been pushing that, and you want to kill, for example, the finance industry in New York, tax on realized gains.
God,
you cannot operate a fund, especially a venture fund, if you're paying taxes on unrealized gains. Warrants become taxable upon the exit itself, and I don't know anyone rich enough that does what we do who could just choose to keep paying the taxes along the way instead of warrants. Yeah. So that's why warrants.
Yeah, and it also allows you to I think be a little bit freer to invest in these companies and take equity for services in them because you don't have that immediate obligation of the tax hit, right? The cash.
Right.
And so I think that also aligns what we want to do, which is just find really great founders that we believe in
now.
What about
class of shares?
So we do preferred.
Yeah, same thing.
Yeah.
We will walk away, any founder listening to this thinking about us, if you will only pay us in common, there's a 0% chance we will do the deal. Yeah, because at the end of the day, in every company, something eventually goes wrong. And the people of common are the ones that get fucked every single time.
Do you see the boards of the companies when you go? Now we're getting really wonky, but I love this. Do you see the boards of the companies pushing back when you?
They do sometimes. And then what we have found is, one, I'm able to show them, okay, here are literally 50 examples where we got preferred, and most of these companies are a lot more impressive than you, and most of the time that's enough.
Yeah.
And the other one is just I have a weird negotiating style, which is I'm not a great negotiator, but I also just kind of know what I will and won't do, and that's it. And if it doesn't happen, so be it, right? This is a consulting firm with fees and everything else, and so I just won't do it. So if you don't, by the way, if you're not willing to give me preferred, you probably don't need us in the first place, right? And if you need us that badly, you should give me whatever I need because it's going to multiply for you tenfold.
I think for us, it comes down to the trust with the founder and the trust with the co-investor. So oftentimes when we are doing a structure like this, Nahal, who's our co-investor, we've done multiple investments with him.
Yep.
So he comes in and he says, hey, I vouch for this guy. I'm your board leader.
Yeah. And that also gets back to also the public credibility thing, right? Yeah. So the guy from Lightspeed, he knew who I was because I'm out there, right? And so that's another reason why it makes it easier to argue for it. But I just think you would be crazy to take common and make that kind of bad.
Yeah, I mean, to put a cap on the whole thing, I would tell I would tell founders, understand the incentives of your investors. That's, coming back to the thing that we were saying here about 100%. Your fund size, where are they in their deployment cycle?
Value add, all that.
How many investments have they already made? How's their fund doing? These are all things that founders don't ask enough of their investors. I love it when a founder spends the first 5 minutes of a 30-minute conversation understanding, what do you invest in? What are the last 3 things that you did? Am I in your wheelhouse? Am I an
rarely
exception?
get that question.
It's crazy, right? But do you appreciate it when a founder does it?
Of course, because then I feel like also it's like a marriage, right? It's if it's 10 years, 12 years. I mean, there have been companies where I like everything except the personality of the founder. And I'm like, I don't want to work with this person for the next 10 years.
Yeah.
And so I'm not going to do the deal, right? Because those are 10 years of my life too, right? I've had companies that have failed and I'm just happy because I no longer have to be on the board, right? And I'm like, you know what? Fine. Like I'd rather have not lost the money, but at least I'm fucking done with this thing. So yeah. And then what do you guys do about pro rata? Do you insist on it?
We take, so we have a side letter typically that we'll do for pro rata.
Same.
And then we will, I think 95% of the time we've taken it. There's maybe only one time that we haven't.
Once in a while,
once in a while we just don't believe in it and we don't take it. But I feel like if we want pro rata at the next round, that we'll take it, and occasionally we'll even double down with more, again, because we have the fund.
Same thing. Or that, or what I have found is if you are really value add, so I have companies where they're way oversubscribed, but they'll come to me and say, hey, if you want an allocation above your pro rata, we'll make it happen because we want you to be as incentivized as possible to prioritize us.
That's right.
So therefore, and oftentimes in that case, it's usually a really good company. I'm like, great, I'll take it. And then I'll do an SPV. And sometimes I might say I'm just good with what I have. But I do think that's, so to me, if you're listening and you're looking at an equity services model, pro rata warrants and preferred should basically be a non-negotiable provision. And if you can't get that, my advice would be 99 times out of 100, it's not worth doing.
Do you think more agencies are going to pursue this model, like a SEO agency or a sales dev
there
agency?
Should, in theory, be almost an index of who does this in each sector, right? One of the reasons that I have negotiating leverage is there still aren't really a lot of other people that do this in the regulatory space. And so therefore, I don't have a ton of competition, which gives me more leverage in a negotiation. But keep in mind, to get to where we started, you have to be so exceptional what you do that people will give you equity in a company. That in an equity company, you want equity in, right? People will give you equity in shitty companies all day long, right? 2, you have to have the cash flow one way or another. It could be because you guys take fees on your fund and that's what enables you to help cover some of your costs. It could be because you have other businesses like me where there's other revenue coming in, whatever it is. And 3rd, you have to have the risk appetite to do it because a lot of them are the power law applies and, the math overall should work. But, a lot of them are going to go to zero and you have to pay your employees every 2 weeks, whether or not there's an exit, right? And so you have to be comfortable taking on all of that risk.
Let's close here looking at maybe 5 years into the future for founders and for emerging managers specifically, because that's people who listen to the show. For founders, what do you think changes for them from an availability of capital, from the kinds of options of funds they have if we look at 5 years from now? And for emerging managers, what do you think changes about how funds are going to be built?
So for founders, just be mindful that this stuff is very cyclical, right? And so you had this period of sort of irrationality where companies were getting 30, 40, 50x, ratios, and most of those investments really did not turn out well. Then you had a period of a little more rationality and austerity where VCs actually asked things like unit economics and margin and things like that, right? And then now it's sort of bifurcated. If you're an AI company, the rationality is gone again. If you're not an AI company, people are actually focused on the fundamentals. But if there's a saying, this too shall pass, right? Good and bad, this too shall pass. If you are an AI founder right now, there's gonna come a point where there's gonna be some huge winners and a lot of failures, because that's simply how venture capital works. And then there's going to be a pullback in the just throwing money at stuff. So don't assume that this level of capital is always going to be there, and that should be impacting your choices around how much you raise and how much you spend and what you spend it on. For managers, and I don't know this is really an AI thing, I think it's that in that period of irrational exuberance, 2 things happened. 1, valuations were wildly out of control. But 2, too many funds were created without a real reason. So just like we went through in pretty specific detail when it makes sense for when someone's a value added, when someone is not, a lot of people who had a good exit in something or they were at a VC fund or whatever it is were able to then raise their own funds. without any real reason to exist. And most of those are going to be washed out. And so I think that if you are a founder, it gets back to the underlying premise that we started with, which is you have to be able to say, I am such a good fundraiser. And keep in mind, if you're a good, like one reason I'm not a great fundraiser is I don't really schmooze, right? I don't want to hang out with LPs and play golf with them and go to a strip club with them or whatever it is, right? I want to hang out with my kids. I want to go to Knicks games with my friends. Like, I don't even take other people to Knicks games other than people I just want to hang out with, right? So you have to want that lifestyle, right? If you are like, let's say you run a hedge fund, right? Your job is to raise institutional capital, not to invest. And you go all over the world constantly whining and dining, LP allocators of big institutional capital. So if that's you, great. Or if you have a very specific value add, where you're like, I know that I can really do something for companies that others can't. And then you can debate whether to have outside capital or not. And this whole podcast would help you think about that. Yeah. But that's a reason too. But if you're not one of those two things, I'm not really sure why you should have a fund.
Yeah. Yeah. That's a good place to leave it and a good thought point here. I think you're absolutely right. And, Peter Walker from Carta puts out really great data about just how funds are performing and where they're at. And the more time I spend with kind of fellow GPs, I think everybody is, especially if they're going from fund 1 to fund 2 or fund 2 to maybe a larger, more institutional fund, they're all thinking about this conversation. And it matters for founders. And I often tell founders, like, yes, when you listen to a VC podcast, understand what they're talking about because it does impact you. The fund sizes, the availability of capital, how VCs are expecting you to grow, what growth they expect from your seed to your Series A is all predicated on the incentives built around their fund.
100%.
And so I'm so grateful that you came on today.
This was literally, I go to a lot of podcasts. This was one of the most fun podcasts that I have ever been on.
That is very, very, very kind of you to say thank you so much. And we'd love to have you back maybe a year from now and we'll retrospect again.
Sounds great. Thanks, Jay.
Thank you, Bradley.